You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back here for Education Wednesday, another episode of Options Bootcamp, the premier options educational program. In fact, for all of you pro folks, this is episode 2 of yet another Options Bootcamp doubleheader. Man, we are spoiling you folks. You guys already heard 2 last week. We got 2 more coming at you this week. All you on-demand folks, you'll have to wait to see when these hit the network. We're going to sort out the release schedule. We got a little bit of travel coming up, and Dan's got his big retreat. So want to make sure you guys have boot camps in your lives for the next couple of weeks. So a lot of good episodes coming at you as well, just on the old on-demand schedule. Where do you go if you want to join the pro folks? You can listen live. You can ask questions, join our pro Q&As, our options oddities, get access to all this growing mountain of things we're giving away here for our pro trading crates, and a whole bunch more. theoptionsinsider.com/pro. Or for you cool kids, /secret club. But don't tell Dan. He's not invited. He's not a cool kid for the secret club. And of course, if you listen on demand, you like what you hear, all we ask is that you keep rating and reviewing the show. It does help the literal legion of new people who are discovering this program all the time. We love you all, including this week we got our 5-star review from Decane. Let's go with Decane. That looks like how it's pronounced. Decane says, yes! Exclamation point, all in caps. Yes! Good lessons here. Well, thank you, Decane. I say yes to your review there, sir. Thank you. I appreciate it. So wherever you guys are listening, again, this show's been around for a while. It's got a lot of great listeners, a lot of great love on all the podcast platforms, but you can argue the new stuff more important than ever for the legion of new people who are discovering options these days. And you know what? When they discover the show, they then tend to discover my cohort here, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring, and the author of 1 or 2 or perhaps half a dozen options-oriented tomes. Mr. P, welcome back to Options Bootcamp, sir. How you doing?
So good to be back, Mark. This is wonderful, and I am ready for another episode. Let's do this thing.
All right, let's do this thing. It is time for some basic training.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes,
sir. All right, everybody, welcome to a little bit of the old basic training. And, maybe we should dim the lights. Maybe our producers can put in a little bit of Barry White on the background there on the music bed, because we're going to get a little sexy on the show today, Mr. Dan. Are you ready for perhaps the sexiest of options topics you could possibly handle, Mr. Dan?
Ooh, I love sexy options topics.
All right, picture this, a little bit of a Barry White tone, a little bit of music going on in the background, listeners. Dan, what would you say if I told you today we are about to enter the super, dare I say it, uber sexy world of cash secured puts. What say you, sir?
Oh my goodness. I need one of those little like sound effects panels to play some like lewd moans or something.
Yes, that's what we need to get ripped off of the clean on iTunes. You need a little fan so you can fan yourself like a southern debutante. You're going to pass out from the vapors, sir, after hearing about all the super sexy world. Of course, I joke, not exactly the sexiest of options trades, but an important one to understand and a growing trade in terms of popularity. We have seen more people talking about it and posting videos and other things about this strategy. So it seemed like a worthwhile one to explore. Now, we have explored selling puts many times in the past on this program. You can go back again, check in the archives if you want to look at those in various varieties. Straight up selling put as a stock entry tool, short put spreads. That's one of our favorite ones as well. Today we're taking a little bit of a different spin on this. So what are we talking about? Cash secured put. What does that mean? I've heard that's kind of like a no risk type of strategy. I love it. It's all cash secured. What can go wrong? Let's walk through an example, shall we? All right, XYZ. Super sexy name. Everybody loves it. Hot. I hear good things about XYZ. If you haven't bought some XYZ, you might want to get in on it. SEC, don't come at me. I'm just putting out my own personal opinion out there. XYZ, in our example right now, trading right around $100. So it's pretty frothy. It's got some juice to it. You're coming in and you're saying, I like this. I like this name, and I want to get a little bit of action on here, but not here. Not at $100. I'm not comfortable at 100, but maybe at 90. If it drops to a 90 in the next month or so, maybe I'll get in there. So a nice little 10% retracement, I'll get in. So what are your options, pun intended, at that point, listeners, right? You can come in and say, I'll work a limit order to buy the stock at $90. And again, we've seen this play out time and again in the markets. Working any sort of limit order in an equity these days entails risk. You are incurring risk in your portfolio, in your account, for no reward. So if you're working a limit buy order in a stock, we've all seen stocks can easily blow through those very easily, right? Next thing you know, the stock opens below your strike and you're filled. Maybe you're filled above it. Maybe you're filled at some other crazy price in between. But still, it can obviously blow through your strike and incur a lot of risk, and there's no real reward for that at all. To the upside, we've seen people working orders to sell stock. They get blown through in a name like a GameStop or an AMC, or pick any one of the other meme stock paloozas over the course of the past year, and they missed out to the upside. So there's risk in both directions. So we've always said on this show, if you're going to work equity orders, you should be compensated for that. So that's where the options level comes in. Now, instead, you could turn around and sell. In our example, let's say you're getting a decent amount of juice. You're going to sell the 90 strike put going out 1 month, so only 1 month. And in our example, you're going to get $1 for that. That's a fair amount of juice. Probably wouldn't get that much in the real world, but for our example, we like nice round numbers that are attractive. So you're going to go out, you're going to sell that 90 put for $1. So now what happens? Of course, first off, you effectively are agreeing to buy that stock at the 90 strike minus the $1 you are collecting. You're being paid for that. So that's effectively the price of 89. So already you're seeing you've lowered your effective buy-in price for the stock. And of course, you're selling a put to someone else. The put is the right to sell an option at that exercise price. So you're guaranteeing someone else the right to sell that stock effectively to you, even though we know that's not technically how it works. OCC, a lot of other things, backstopping in there. It won't be the same person. But let's just think of it that way, that you're effectively guaranteeing they can sell that to you at any time for the lifespan of that option for $90 minus the $1 you're collecting. So now you know that. You've heard that before on the show. You know what a short put is all about. You know how to use it as a stock entry tool. But in our case now, let's say you're big time. Let's say you want to do a 10 lot. You want to do 1,000 shares of XYZ at $90. So you want to shell out $90,000 for this stock. In this case, you're going to turn around and sell 10 of the options. Remember, the multiplier is 100. So 10 contracts is going to equate to 1,000 shares of the underlying. So in this case, we're selling that for $1. So $1 times 10 is $10 times 100, which is the multiplier. That gets out to $1,000 you are collecting to put on this position for 1 month. You might say, hey, that's great. $1,000. I'm not doing anything, just working a stock order. I'm getting paid. I like it. I can replicate this over time. $12,000 on the year. If I can keep this up, that's nothing to sneeze at. So you might be intrigued by this. Again, these numbers are probably a little bit inflated. So don't look for that in the real world too often. Now, what makes this cash secured? What are we talking about here? Now we're going to go above and beyond. I said you're going to buy effectively 1,000 shares at the effective price of $89. Most brokers, if you're doing a traditional brokerage account, will have you put aside some balance, some margin balance, some collateral to cover this. We can get into how that's calculated in a second. It's a bit of voodoo, trust me. But what makes it cash secured, and this is the way you have to go if you have a cash account where there is no margin effectively, a lot of the retirement accounts out there, that's kind of the way you have to go. You have to set aside the full amount to buy that equity at the start of the trade, at the onset of that trade. So in this case, your broker is going to set aside $89,000 to just sit there in your account for that month. Now, it's up to you to decide if that's worth it. $89,000, that's money you could put to work doing something else. So there is a sizable opportunity cost to this trade. Is that worth the $1,000 you're being paid? Well, that's up to you. But again, that's something to decide and consider if you're going to do this trade. Now, Dan, we have seen an uptick in interest in this particular strategy out there. Maybe not the past month because a lot of sell-offs out there, but outside of that, it's been a hot topic. It's been discussed a lot. Again, super sexy. What are your thoughts on the world of cash secured puts, sir?
Oh man! So I'll tell you what. I've had a history of thoughts with cash secured puts. Long ago, I focused Market Taker mostly on active traders. Now we've sort of expanded and we help investors as well. But I had a trader, someone who considered himself an active trader, who would always do cash secured puts, and I would tell him, as a trader, I'd rather see you do credit spreads, and he'd say, well, no, they're cash secured. And I was like, yeah, but still, I mean, in your example, Mark, your broker wants $89,000, and that's really what's technically at risk, right? And then as we moved into, like, when I started the MTM Smart Income System, which is for investors, it's like our covered call and cash secured put program, I really embraced it. And now I trade cash secured puts and covered calls pretty much every day. For me, I look at it very, very specifically, though. I still hold that if you really want to skate and not get assigned, you're just trying to make money because you think it won't fall below there, you're still probably better off with credit spreads. When I do cash secured puts, I actually want to get assigned. And a lot of people who, they read a book on this, and they say, oh yeah, I'd be fine if I get assigned at at $90 a share. And then they get assigned, they're like, this is terrible. I don't want to get assigned at $90 a share. No, I literally really do want to get assigned. And even if the stock's trading at, 70 afterwards, it's just like, hey, if I bought Apple at 180 and now it's at 160, I'm still in it for the long run. As soon as I sell that cash secured put, I look at it as if, hey, I own the stock at the break-even price. And I look at the worst case scenario is if it goes up to 110 and I leave a bunch of money on the table. I make money, I make my maximum amount on the put. But to me, that's the worst case scenario because it's a stock that I want to own and I want to buy it at that lower level. So I think that that's how everybody should look at it, but I think very few people look at it that way. And to answer, I think, the question that you originally asked, have I been seeing a lot of interest in this from our folks? I would say, unfortunately, no. I'm the one who's bringing up the issue with our students. A lot of folks are really scared because the market's down right now. For those of you who are listening to this live on, May 25th, 2022. And there's a good chance the market's going to continue lower too. But if you're sitting in cash, it's a great way to scale in at even lower prices than where stocks are right now. Now is the time to be thinking about these things. I'm not saying just go sell cash secured puts on everything. But the stocks that you like long term that you think are undervalued right now is a great time to do this.
It is an interesting strategy and a lot of names out there. I highlighted on our last episode last week. I use this exact strategy in some names like Palantir and Robinhood with interesting effects. Listen to that episode if you missed it. We're talking about luck. on that episode. And again, that's kind of the first step in risk management we talked about many times with selling puts. Are you comfortable getting the stock there? It's kind of the first level to it. Now, people often get confused when they hear this term cash secured. They see secured and they think, okay, this is a low risk type of trade. It's secured. What can go wrong? What can happen? Well, as Dan kind of just broke down, this obviously, if you think about it, you're just working a limit order to buy the stock at that price. So anything that could go wrong with buying the stock at that level could go wrong with this trade. So you could obviously have a lot of downside. In our case, $89,000 worth of downside. That's a sizable amount of downside. So be prepared for that. Just because it has secured in the title doesn't mean it is a low risk type of strategy. So if you're using this as a way to get into an equity position, make sure you really are comfortable picking up the equity there. And if it gets down to that strike, don't get wishy-washy. I mean, that's your first level of risk management. The other risk I mentioned before is kind of the opportunity cost that goes into this trade. And the opportunity cost, how to calculate that is a bit challenging. We won't get too much into the voodoo of how brokers calculate margin for short put positions. Trust me, it is very much voodoo. It's going to depend on your account size, the type of margin you have with your broker, whether your broker likes you, all kinds of weird stuff. If you're a big enough account, you can kind of get away with almost anything, it seems like, out there. But different brokers margin short puts in different ways. And I was just doing a cursory glance at some of the different ways we can do it. And some brokers even try to make it a little bit more user-friendly. I won't mention the broker we're looking at right now, but they try to make it user-friendly by showing you how they calculate the impact to your buying power. Can be one of three ways, and they list those for you. So we'll do some examples for you really quickly so you can see kind of the opportunity cost that we're talking about. The first of these is 20% of the underlying price minus the out-of-the-money amount plus the option premium, or 10% of the strike price plus the option premium, or $2.50, whichever is greater. Then, of course, you have to multiply times the number of contracts times the multiplier. So, Dan, all that seems very straightforward. No confusion there at all, right, sir?
Oh, yeah. As clear as mud, as they say.
Yes. Thanks for clarifying that, Broker X. And, a lot of brokers do the same thing. So I won't name them, but a lot of them are in the same boat out here. So in our example, we talked about XYZ being at $100. So 20% of that underlying would obviously be 20 minus the out of the money amount. So you're talking $10 there plus the option premium, which was $1. All that works out to $11 times the number of contracts, which is 10, times the multiplier, which is 100. That's $11,000 they would set aside in this example. Remember, they're looking for the greater of the three. Or you have the other one, 10% of the strike price, easy for me to say, 10% of the strike price plus the option premium. So that works out to $10 or $10,000. Or the other one, $250, which works out to $2,500. They're going for the greatest of that. So it would be $11,000. So you're talking a very sizable opportunity cost, $11,000 versus $89,000 for the cash secured put. That's $78,000 worth of opportunity cost. Is that worth it for you for that $1,000 you're collecting? Perhaps not. And if that's not, then perhaps the example Dan mentioned maybe is the way to go. And that's the way we've counseled in the past as well. If you're not sure, you really want to pick up the underlying at that level, if you're really, in your heart of hearts, really just doing this as an income play, then you're probably better off with the short put spread, the credit spread, as Dan was alluding to. So let's amend what we just talked about. Let's take the cash secured put and sell that put at the 90 strike again for $1. But let's come back now and say, you know what? I have $89,000 worth of risk here. Maybe I don't really want to buy this stock for $89 at the end of the day. So, I'm going to come in. I'm going to buy, let's say, the 80 strike put against it. So 10 handles below. And in our example, you have to buy that for 40 cents. So now instead of selling that put for $1, you're selling that put spread, that $10 put spread for 60 cents. So you have cut your profit from $1 to 60 cents. You've also cut your risk from $89,000 down to $9.40. Remember, that spread can only be $10 wide. You collect the 60 cents to sell it, so the most you can lose is $9.40. So still a lot of money, but a heck of a lot better than the alternative. And also from an opportunity cost, this is not going to tie up an additional $78,000 worth of margin. It's only going to really margin that $10 out there. So much more attractive from a opportunity cost perspective, much more attractive from a overall net risk perspective. But again, if you're looking to use short puts as a way to get into an underlying, the cash secured put can be an option. Just be aware it's not safe because it says secure. And also there is an opportunity cost that everyone forgets to factor in when you're doing these. Dan, any other last thoughts on cash secured puts versus put spreads before we roll on to some questions?
Yeah, no, that is a good point about, opportunity cost and that. And man, I'll tell you, to me, a very healthy attitude is to, if you're looking to trade into the stock, just to think about it. As soon as I sell the cash geared put, I own the stock. Just think about that in your mind, because like there's two objectives you can have: skate, which means try and not get assigned and just keep the premium, or trade, as in trade into the stock to get assigned. If you know your objective out front and you that really truly is your objective, it's almost like you can't go wrong. Sure, the stock can go down too much, but if your objective was to trade into the stock, then it's okay. It's part of a long-term play and you can write calls against it, et cetera, et cetera.
And we can't go wrong answering some of your questions.
Mail call. Time to look at questions submitted by our listeners.
All right, Mr. P, let's do it. Let's unleash the masses upon us. First, let's turn the spotlight back on them quickly. We have our question of the week this week. And we've asked you in the past, and a lot of you right now are in cash looking to buy the dip. We've asked about the levels you're looking to buy the dip, and a lot of you said around the 3,700 level was the level you're looking to buy in. But some of you have also mentioned about capitulation. You're looking for capitulation in the market. So we thought we'd ask you about that this week. A lot of you are waiting for that vol spike before you dive back into these markets. What level does VIX have to hit to signal concession in the broad market? Gave you four choices: VIX north of 40, VIX north of 50, VIX north of 60, or VIX north of 70. Mr. P, I turn that question to you. First off, are you a believer in that theory that we not only need to see the SPX sell off more, but we also need to see vol really get a lot higher to signal that the bear is coming to an end? So what are your thoughts on that? And then B, if so, what do you think that level is, and what do you think our audience is voting for?
I think that probably is the case, that SPX probably does need to sell off a little bit more. We probably do need some capitulation. It is certainly possible that it, just somehow magically starts to drift up one day too. I'm pretty hard pressed to see a news catalyst that would just turn everything around. And not have capitulation. And consequently, of course, the VIX would have to rise more as well. I don't know if just kind of like process of elimination here. I don't know if it's going to need to hit 70. I don't know if it has to be a scenario like that, but I could see 50 as being, maybe a number where, if you're not selling puts to get in, it is definitely it's definitely time for me to start doing it.
Dan will be doing it. I don't know about you. So you're at 50. You think our audience is there too?
I bet they say higher.
Interesting. So right now, Dan's at 50. Our audience, 40.6% saying north of 40. That's all they need. So just a little bit of a pop in VIX. Followed by 24.8% for Dan's level, north of 50. And then 24.1%, we jump all the way up to 70 for number 3. And then only 10.5%, no love for 60, Dan. Only 10.5% for 60. So for 60, they say pshaw. It's 70 or bust for a good chunk of them out there. So there you go, listeners. That's our question of the week. People have been debating this back and forth. It's got a lot of good discussion around it. Probably discuss it more on volatility views later this week. A lot of people weighing in on Twitter on this concept. Do we need vol to spike to signal concession in the broad market, yes or no? What are your thoughts? If you have thoughts on that, not just vote in our poll, but also you weigh in with your reply. Maybe if it's interesting, we will discuss it on the show. All right, let's get out some more of these questions. Let's go to Meats with a Z. Good to see Mr. Meats back. He's been back on a tier this past week. Pro Q&A now out here. Meats says, I know Dan has dabbled in crypto in the past. What does he think about the big sell-off last week? Obviously, it came in a couple of weeks ago. Last week, and the complete meltdown of Luna and stablecoins. So, Dan, back when I was down at the OIC conference a couple of weeks ago, we saw, of course, that huge meltdown in crypto with the Luna and the stablecoins. Meats wants to know, what are your thoughts on all that madness, sir?
Yeah, I mean, it's looking like crypto's a long-term play, but in the long term, I think it's a play. You know, I read this book. It's called Digital Gold, I think it was called, written by some guy, Daniel. I think his name's Daniel Popper, who writes for New York Times or something. I just gave 3 bits of information. I'm sure 2 of them are at least partly wrong there, but anyway, like it kind of explains the history of Bitcoin, and Bitcoin, was this idea for an alternative sort of democratized currency, anti-fiat currency, and then other cryptocurrencies started. But now I don't look at crypto as a currency at all in the future. I look at it more as a product, and you can basically buy direct shares into the product, which is the crypto asset itself. Because as Web3 continues to roll out and develop, there is a need for many, many smart contracts that are best built on a on a backbone like Ethereum or Solana, or something like that. So I think that especially those cryptos, I'm not even going to say coins or tokens, especially those cryptos that are not currencies, and especially the ones that are a little bit more eco-friendly, that are more like for stakeholders, as opposed to whatever else. Those I think have a future, but there's a lot of negative energy right now into it. If I were to buy something for the next month, it wouldn't be crypto. But if I were to buy something for the next 5 years, it would absolutely be crypto.
Well, speaking of not quite that far out, 5 years, but out to July, this next comment comes from Tim. He says, I hope that listener got out of his July 50 double call spread in Twitter. Looks like Mr. Musk is going to back out of or reprice the deal. Either way, it's killing the stock. Yeah, I was thinking the same thing. I forgot the name of our listener who wrote in a few episodes ago asking about his 50-55 call spread in Twitter, what he should do with it, because there was still a lot of question to it. We counseled him if he was a little worried to get out of it, of course, but if he wanted to take the risk, he could wait it out. He still had some value in it then, obviously. Obviously, less value now. You all know the story. I won't regale it for you. Twitter right now, $37.12. So up $1.34 today, looking a little bit better today. Got down as low as $35.62, but obviously a long way away from the 50, let alone the $54.20 price that Musk had talked about. So this is the guy who's going to do his due diligence in public after he announces the deal. I don't know what to tell you, except if you got in on this trade, you had to expect a little bit of drama, and you're unfortunately getting it now. So I don't know what the listener did, Tim. Hopefully they got out, but maybe we'll hear from them and see. But yeah, that was a rough one. They were kind of waiting for more information, I think, on the shareholder vote and what was going to come down from OCC before they made a decision. And unfortunately, Musk decided for everybody and decided he didn't want to pay that level anymore. All right, let's go out to Trevor. Trevor, a lot of T names today. Tim, now Trevor. Trevor says, your episode on time spreads has inspired me to research them more. Well, you're welcome, Trevor. Or should I say I'm sorry, because you're going down a rabbit hole now. It's an interesting one, but also an intricate one, so enjoy. He says, I'm already listening to all of the back episodes of OBC on time spreads to learn more. I think I'm starting to get it now. I'm also looking at the daily S&P contracts, and I'm starting to think about intra-week time spreads. Have any of you experimented with this? What are your thoughts on this approach, risk or potential opportunity? Well, interesting timing, Trevor. I just got off the Advisors Options show with our buddy, Mr. Matt Amberson from ORATS, and we had a good discussion about intra-week time spreads on that very show. I encourage you to go check it out. Matt spends some time breaking down all of the various legs and permutations he adds to his weekly, or I should say intra-week time spreads in order to hedge out the risk. A little bit more intricate than perhaps you may have assumed at the outset. So I encourage you, Trevor, if you are intrigued, go check that out. It was a fascinating conversation. But Mr. Dan, he's right. We are seeing the new listing of effectively dailies in the S&P. It's probably coming down the pike for NASDAQ and other big indexes. So the notion of intra-week spreads are starting to line up, not probably in your big equities yet. It's going to take a while, but in the indexes it's there. Have you experimented with this? What are your thoughts on the notion of, let's say, a Tuesday, Thursday calendar rather than a weekly or monthly calendar, sir?
I think that there's great opportunity when it comes to this. Anytime you roll out more ways to trade an already liquid contract, especially one that is, what's the right word? Partially fungible, like SPX to SPY to E-minis to S&P 500 options, at the mark. Whenever you roll out more ways to trade that, it magnifies liquidity. It has potential to magnify liquidity exponentially because there's so many arbitrageurs out there trading that they trade in and out of stuff, and they just have more opportunities for arbitrage. And so it ends up being, just by nature, pretty liquid, a lot more liquid than if you were just to roll out some, new options on, joeshotdogstand.com stock. So yeah, there's great opportunity. Yeah, I think it's fantastic. Why not?
I agree with Dan. I think it's very cool. They're pretty new. I haven't had a chance to really dive into a lot of intra-week time spreads yet, but it's something I'm looking at as well. The standard time spread, in fact, the example we laid out on our recent episode was the monthly time spread, but yeah, you can do it a lot closer to home now, which is interesting. You could trade time spreads around earnings events now and announcements. There's a lot of things you could do that weren't really possible before. So intriguing stuff. It would be fun to have them in the single names. Again, I did a great sit down with the CEO of the Options Clearing Corp. That's going to be hitting the network sometime soon. And you'll hear in that conversation that they're still not there yet on these single names from a daily perspective. It's too much risk. They can't really calculate the settlement prices they need to calculate in terms of if there's a surprise cash dividend or a corporate action. They can't do that on a daily basis, right? They need a little bit more time to do that. So indexes don't really have that problem, so they don't have to worry about that. The corporate actions aren't there. But on the single names, your Apples, your Teslas, whatever, your Twitters, probably going to be a little bit longer on there. So that would be much more interesting to me. But in the meantime, the index intra-week time spread certainly is intriguing. So great question, Trevor. Maybe that's something we'll look at on a future episode. Maybe we'll revisit time spreads yet again, but this time much closer to home in the intra-week type of category. Could be kind of fun. So check it out. Meantime, also check out the advisor's option, particularly the beginning there where we talk exactly about this topic, Trevor. So well-timed question. Mr. Dan, speaking of time, we are out of it yet again for this week. But before we go, Mr. Dan, if folks are intrigued, they want to hit you up, maybe they want to join you for a little bit of the old retreat, where should they go? What should they do?
Man, I will tell you what. Let's see, today's Wednesday. I'm getting on a plane in 1 week heading out for the retreat. And if you want to come, you're going to have to do the same. Nothing wrong with last minute. And I can pull some strings and get you a really great discount. So head on over to markettaker.com, hit contact us. And if you want to come next week, just let me know, and I'll get you hooked up. It's great. It's our annual in-person event that wasn't in person the last 2 years because of the pandemic and all that. But we'd love to meet you in person. There's going to be a lot of great people there. It's a really wonderful experience. Come on by, last-minute decision. Live a little. Serendipity.
And I was going to join you. Dan kindly enough offered to bring the Concorde out of retirement just for me to fly me out to the event. But alas, Dan, I have been called to coach in the Super Bowl of flag football here in Chicago. So alas, I will not be able to join you. But it sounds like a fun time. I encourage you folks to check it out if you have not already. MarketTaker.com. 2 T's is the place to go to learn more. We have to get on out of here. But don't worry, listeners. If you need more in your lives, you already had 3 shows today. If you need more live, we're coming back at you with at least 1 more, maybe 2. So look forward to OPR for all you cool kids in Secret Club. Pretty much immediately following this, about 20 minutes from now, we'll have Brian on. All sorts of good stuff. 1 episode live to tape and 1 episode live to you folks. So you got more Q&As coming at you. My voice will be dead. And then, of course, tomorrow we have TWIFO and episode 2 of the Option Block. Friday, volatility views. If you have questions about vol, check out that one if you haven't done so yet. As well as for all you cool kids in Secret Club, Options Oddities. Then back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.